Hello everyone, welcome to Chapter 24. This chapter will focus on swing trading and its details. We'll cover the two different approaches to swing trading, the timeframes used for each, and the process of evaluating which approach is best for you. We've already discussed trading in general, and now we're diving specifically into swing trading. By the end of this chapter, you'll have all the information you need to understand swing trading and determine whether it suits your personal style. Let's get started. First, let's break down what swing trading is. Swing trading is a trading style focused on capturing price movements over a period ranging from a few days to several weeks. The main objective is to capitalize on swings within a larger order flow candle range, aiming to profit from price fluctuations during weekly and monthly range expansions. That's the basic definition of swing trading. We'll go over the specific methods and approaches in the next section. But for now, let's dive into the key characteristics that define swing trading. One of the most important aspects of swing trading is the time frame. Swing trades typically last between 2 to 5 days, but can extend to a week or even 2, depending on market conditions. This time window allows traders to capture meaningful price movements without the intense demands of intraday trading. The primary objective of swing trading is to exploit price swings within a high time frame trend or range. By focusing on these larger moves, swing traders can target higher profits compared to short-term traders, such as scalpers or intraday traders. Swing trading also offers flexibility, acting as a middle ground between intraday trading, which involves frequent short-term trades, and position trading, where trades last weeks or months. This flexibility makes swing trading suitable for a wide range of traders, including those who have other commitments in life. One of the biggest advantages of swing trading is that it requires less screen time. Unlike day trading, swing trading doesn't require constant market monitoring. Once a trade is placed with a stop loss and target, traders can let the market play out without watching the charts all day. Swing trading is also ideal for those who have other commitments, such as a full-time job, studies, or family responsibilities. It allows traders to participate in the market part-time without compromising their strategy. Another key benefit is the potential for higher returns. By targeting larger price movements, swing traders can achieve higher profits compared to intraday traders. Since trades are held for longer, traders can capture broader trends and significant market moves. Additionally, transaction costs are generally lower compared to frequent short-term trading, reducing commissions, slippage, and spreads. If you prefer to analyze the market at your own pace and aren't drawn to the fast-paced nature of intraday trading, swing trading might be the perfect fit for you. It's about focusing on the bigger picture, aligning with market trends, and giving your trades the time they need to develop. Now let's move on and expand on the key points of swing trading. We've already talked about what swing trading is, but now we'll focus on its specific goals, characteristics, and how to determine whether it's the right choice for you. The primary goal of swing trading is to capitalize on either the weekly range expansion and price movements happening within a trading week, or the monthly range expansions and price movements occurring within the trading month. As a swing trader, you are not looking to trade every fluctuation in the market. Instead, you focus on the larger moves that align with the higher time frame objective and liquidity draw. One key characteristic of swing trading is that it provides a limited number of setups per week. Typically, swing trading offers around 2 setups per week, depending on the specific approach used. If you follow the one-shot, one-kill approach, you may get 1 or 2 setups per week. However, if you trade with the classic swing trading approach, you might only get 1 setup per week, or even 1 every 2 weeks. We will discuss these different types of swing trading later, but it's important to understand that setups are limited. You must be mentally prepared for this and accept that patience is a key part of swing trading. If you're not mentally ready, you may feel the urge to force trades, which often leads to unnecessary losses. The hardest part of swing trading is waiting patiently for the right setup, rather than forcing a trade that doesn't align with your high time frame context and framework. Swing trading isn't about constantly being in the market. It's about waiting for high probability opportunities and only engaging when the conditions are right. Another crucial aspect of swing trading is the use of higher time frame confluences. The more high time frame confirmations you can find to support your trade, the better. For example, aligning a weekly liquidity pool with the daily open, high, low, close levels, or key standard deviations adds confidence and precision to your trade. The more confluences you identify, the higher the probability of a successful trade. Swing trading also allows for greater flexibility around news events. Unlike intraday trading, swing trading lets you take advantage of major news events by positioning yourself before or after a release, exploiting the market's volatility for larger moves. Since the goal is to capture weekly and monthly range expansions, these expansions often occur following key news releases, providing swing traders with opportunities to capitalize on them. Now that we've discussed the key characteristics of swing trading, let's talk about the two different models or approaches. There are two main approaches to swing trading: the classic swing model and the one-shot, one-kill model. The classic swing model focuses on capturing monthly range expansions, making it a long-term approach that offers only a few setups per month, typically around 2 to 3. On the other hand, the one-shot, one-kill model is a more precise approach that targets a single high-probability move within the week, focusing on exploiting the weekly range expansion. This model provides more frequent setups, usually 1 to 2 trades per week. The key difference between the two approaches is that one focuses on longer-term monthly expansions with fewer setups, while the other concentrates on weekly expansions with slightly more frequent trading opportunities. Now, why should you choose swing trading over intraday trading? Swing trading provides a unique balance between the fast pace of intraday trading and the long-term patience required for position trading or investing. It is especially appealing to traders who want to participate in the market without constantly monitoring charts. Unlike scalping or intraday trading, swing trading allows traders to stay active without being glued to the screen all day. Once a trade is set up with a stop-loss and target, traders can let the market play out, using alerts to manage trades instead of watching the price action continuously. Swing trading also appeals to those who prefer a methodical and well-planned approach. It is not about quick reactions, but rather about carefully planning and executing trades with a structured thought process. By analyzing the market on higher time frames, traders have more time to develop a trading plan and generate precise, well-thought-out trade ideas. Additionally, swing trading is suitable for traders who aim for steady growth over time. The focus is on compounding profits, where consistent and disciplined trading over weeks and months leads to long-term success. Rather than chasing quick gains, swing traders build their accounts through calculated and strategic moves that align with the market's broader trends. By understanding these key aspects, you can determine whether swing trading aligns with your trading style and personal preferences. If you value patience, precision, and a structured approach to trading, swing trading may be the ideal strategy for you. Moving on, let's discuss the two main styles of swing trading: the classic swing model, CSM, and the one-shot, one-kill model, OSOK. These are essentially two sides of the same coin. Both fall under swing trading, but approach it differently. Depending on your trading style, you can choose the method that best suits you. Let's break them down to see which one aligns with your preferences. First, let's start with the classic swing model, which I like to call the patient trader's model. This approach is all about playing the long game, focusing on capitalizing on monthly range expansions. You let your trades ride for larger moves, meaning they take longer to play out. Because of this, setups are limited. You might get 2 to 3 setups per month on average, with a maximum of 4 to 5. When it comes to trade duration, positions in this model typically last anywhere from 5 days to several weeks, or even longer if the trend is strong or the market is consolidating. The classic swing model isn't about getting in and out quickly. It's about letting the market do its thing while you remain patient. If you're not a patient person, this style of trading may not be for you. In terms of trade frequency, you're looking at a maximum of 1 trade per week, sometimes even fewer, depending on how many pairs you trade and current market conditions. You're not trying to take every setup, you're waiting for the right one. The key is to be selective and only take high-probability setups that align with the bigger picture. Since your goal is to exploit monthly range expansions rather than weekly ones, patience is crucial. Your primary focus will be on the monthly and weekly charts for higher timeframes. When it comes to execution, you'll zoom into the 4-hour chart for entries. The best way to frame your entries is by using weekly or monthly candle ranges or key levels from concepts like CRT. This allows you to spot clean setups without getting overwhelmed by market noise. If you're someone who prefers a long-term approach, doesn't want to stare at charts all day, and enjoys a structured and methodical way of trading, then this model is perfect for you. It's particularly suitable if you have other commitments like a full-time job, school, or simply want to enjoy life without micromanaging every market fluctuation. The classic swing model is like planting a seed and letting it grow. You trust the process and let the market play out naturally. Now, let's move on to the second approach, the one-shot, one-kill model. This model is all about short-term swings. The focus here is on capturing weekly range expansions with precision, allowing you to get in and out of trades efficiently. Trade duration in this model typically lasts between 2 to 5 days. While it's quicker than the classic swing model, it still falls under swing trading. The objective is to take advantage of weekly range expansions instead of monthly ones. With OSOC, you can expect up to 2 trades per week, which is double what you would typically get with the classic swing model. If you prefer a bit more action while still maintaining a swing trading approach, this model might be the right fit for you. Your higher timeframes will primarily be the weekly and daily charts. For entries, you'll be using the 1-hour chart, framing your setups around daily candle ranges, DCR, and key levels on the daily timeframe. If you like precision, don't mind checking the charts more frequently, and prefer catching shorter but high probability moves, then OSOK is the way to go. This model is great for traders who enjoy being more hands-on with their trades, but don't want the constant screen time that comes with intraday trading. To compare the two, the classic swing model focuses on monthly range expansions, whereas the one-shot, one-kill model targets weekly range expansions. The classic swing model holds trades for around 5 days to several weeks, while the one-shot, one-kill model keeps trades open for 2 to 5 days. In terms of trade frequency, the classic swing model offers a maximum of 1 trade per week, whereas the one-shot, one-kill model allows for about 2 trades per week. Higher timeframes for the classic swing model include the monthly and weekly charts, while for the one-shot, one-kill model, the focus is on weekly and daily charts. The classic swing model uses the 4-hour chart for entries, whereas the one-shot, one-kill model relies on the 1-hour chart. Both the classic swing model and the one-shot, one-kill model are strong approaches to swing trading. The key takeaway here is that it's not about which one is better, it's about which one aligns with your trading style and goals. If you prefer a patient, long-term strategy, the classic swing model is for you. If you want more frequent opportunities and quicker trades, then the one-shot, one-kill model is the better choice. The best part is that you don't have to choose just one. You can experiment with both approaches and see which one feels right for you. Ultimately, trading is about building a process that works for you, and that process will be unique to each trader. Let's move on. In the previous slide, I provided the higher and lower timeframes for both the classic swing model, CSM, and the one-shot, one-kill model, OSOK. In this slide, I'll briefly explain the purpose of each timeframe. You might already be familiar with this, but let's go over it again for clarity and to help reinforce our understanding of the objectives each timeframe serves. First, let's talk about the higher timeframes. For the classic swing model, as mentioned earlier, these are the monthly and weekly timeframes. For the one-shot, one-kill model, the higher timeframes are the daily charts. On the higher timeframes, your main task is to determine the higher timeframe draw liquidity and the directional bias. You'll be considering both short-term and long-term liquidity. If you're using the classic swing model, you'll determine your directional bias on the monthly timeframe. For the one-shot, one-kill model, however, you'll determine your draw liquidity and higher timeframe directional bias on the weekly and daily charts. The second objective for the higher timeframes is building a price-based narrative over time. In this step, you are analyzing how price behaves and using that to guide your trades. The higher timeframes also help identify and select key levels and candle ranges. For the classic swing model, key levels and candle ranges, CRT, are selected on the monthly timeframe. For the one-shot, one-kill model, you'll focus on key levels and candle ranges on the respective daily and weekly charts. Now, moving on to the lower timeframes. On the lower timeframes, your first task is to build a narrative that aligns with your entry model. This means you'll be framing your entries based on the model you're using, whether that's a turtle soup entry or an order block entry model. After that, lower timeframes are used for managing trades and execution. Here, you'll set your stop loss based on lower timeframe logic, such as below a swing low, key standard deviations, or an order block. You'll then manage your trades by either trailing your stop loss, scaling out at key zones or liquidity pools, or holding your trade for the full target, depending on the context and the guidelines you've set for your trade management plan. To summarize, for the classic swing model, you'll be using the monthly timeframe to determine draw liquidity, select key levels, and choose CRT. For entries, you'll switch to the 4-hour timeframe. For the one-shot, one-kill model, you'll conduct your higher timeframe analysis on the weekly and daily charts, with entries framed on the 1-hour timeframe. I hope this makes things clearer for you. Moving on to the next slide, here we'll break down the main premises for swing trading in both approaches. Additionally, we'll discuss the key principles that define each method of trading. As mentioned before, for the one-shot, one-kill model, your main guiding principle is to understand in which direction the next weekly candle will expand. This is known as the weekly range expansion, and it will be the main guiding principle for your higher timeframe market context and narrative. Next, let's talk about the days of the week. In the one-shot, one-kill model, you'll typically find 1 to 2 high-probability trades per week. This means your focus is on quality over quantity. You'll only take trades that position you in the direction of the higher timeframe draw liquidity to capitalize on the range expansion happening on a weekly basis. For this method to work successfully, you need to be aware of the characteristics of each day of the week and understand the role each day might play based on the different combinations of structures and frameworks. Using these protocols and guidelines, you'll position yourself on specific days of the week based on weekly profiles to exploit either continuation or reversal trades. What you'll do is wait for an anchor point to form on Monday, Tuesday, or Wednesday around a key high timeframe level surrounding a CRT, and then frame your setup on the lower timeframe based on that CRT. The next important aspect is your entry model, or how you frame your entry on the lower timeframe. You'll either use a turtle soup entry or an order block entry. If you opt for the turtle soup approach, make sure you thoroughly review the turtle soup chapter I've created, as it's more complex compared to the order block entry, which is simpler and more methodical in its approach. These 3 main premises form the backbone of your swing trading models. Make sure that your thought process incorporates each of them, and that they are carefully considered in your analysis before generating any trading idea or making any decisions based on the higher timeframe. Moving on to the next slide, here we're going to discuss the mechanics of how you'll go about your trading approach. Remember, this isn't just for swing trading. This mechanical and systematic approach that I'll show you shortly applies to both swing trading and even scalping. This is also where we finally dive into routine, because trading isn't just about having a strategy or system. It's about having a structured approach that you can rely on every single trading day. Right, so let's walk through the key steps in the next slide. Moving on, let's finally get real here. Trading isn't just about knowing what's happening in the markets. It's about following a clear and structured process every single day. No guessing, no winging it. Just a systematic routine that guides you from preparation all the way to trade management. Let's break it down. The first step is preparation, getting ready to trade. The reason preparation matters is because you can't just jump into the market without a plan. Preparation is where you figure out the bigger picture, understand what's driving the market, and assess where the price is likely to go. You'll start by checking high-impact news. Write down all the key news events for the week, such as an FOMC meeting, NFP, CPI, or any other earnings reports. Ask yourself, will these events create volatility? Should I avoid trading during this time, or can I use them to my advantage to capitalize on it? Next, you'll analyze the high time frame, monthly and weekly market structure and order flow. Look at the current trend and determine if we're rejecting above highs, breaking below lows, or rejecting below lows and breaking above highs. This will help you understand the order flow. If none of that is happening, we might be stuck in a range. In that case, you can use range dynamics, buying below lows and selling above highs. This context will help you build a weekly profile of how the market might expand. Then, you'll determine the liquidity draw on the high time frame. Within the trading range, figure out where price is likely to go next. Is it targeting a weekly high, a daily low, or perhaps a key standard deviation? After all of that, the next step is to identify and select the key levels that align with your directional bias. These key levels could be in the form of block candles, ranges, breaker blocks, or fair value gaps. This is your entire preparation step. The second step is opportunity discovery, spotting the setup. This is crucial because once you've prepared, it's time to find specific opportunities that align with your high time frame narrative so you can position yourself in a trade and exploit those range expansions. You're looking for setups that have a high probability, backed by a strong market context and the narrative behind it. You'll look for clean candle ranges on your respective time frame. Check the higher time frame for clean candle ranges or CRT, which can potentially be used to frame setups around. These candle ranges will serve as your anchor points for framing your trade idea. And of course, you'll make sure that the opportunity aligns with the high time frame liquidity. If your bias is bearish, you'll look for setups in that direction. However, if your liquidity draw and directional bias are bullish, you'll look for long positions and buy setups. The key point here is that this step is about building confidence in your setup and bringing clarity to it. If it doesn't align with the bigger picture, let it go. Don't approach the market and stay risk-off. The third step is trade planning, which essentially means defining the details of your trade idea. This step is a game changer because it takes the guesswork out of your execution. This is where you decide how you'll enter, manage your risk, and exactly where you'll exit the trade. You'll wait for a liquidity purge or a manipulation profile to occur, and after that, look for confirmation in the form of an order block forming or a clean rejection after the liquidity or manipulation purge. This gives you a precise level on which to base your trade. If you don't want a confirmation entry, you can directly take an AT soup entry. But you need to be fully aware of the complexities involved with AT soup entries. However, if you prefer a more mechanical and systematic approach, confirmation entries like order block entries or fair value gap (FG) entries might be more suitable. Once you've identified your entry point, the next step is to set your stop loss and target. Set your stop loss based on the protocols and guidelines that you've established for your entry model. The same applies to your targets and take profits. After completing all these steps, the last phase is trade execution, pulling the trigger. This is where most traders mess up. You've got your plan, but now the most important step is to stick to it without messing up and ruining the entire process. The final step after execution is trade management, which helps you stay in control. The reason this step matters is that once you're in a trade, your job isn't finished. Proper trade management ensures that you protect your capital while maximizing your profits and rewards. You'll monitor the trade and observe how price reacts to key levels. Is it moving as expected, or is it showing signs of reversal? Based on those critical questions, you'll adjust your stop loss. If the price is moving in your favor, you may trail your stop loss to lock in some profits by taking partials. But if the price shows signs of weakness or reversal, or moves in the opposite direction, you might trail your stop loss to break even or close the trade completely. One important point about trade management is to avoid micromanaging. Let the trade play out according to your plan and avoid the temptation to close early unless the narrative clearly changes. The key is to stay disciplined and trust the process you've built without micromanaging. Now let's move on and break down some examples. Here you can see a price action chart. On the left, we have the higher time frame, and on the right, the lower time frame. Based on the time frames you see, it's clear that this follows the one-shot, one-kill model, with the higher time frame being the daily, and for entries, we're using the 1-hour time frame. Essentially, it's the one-shot, one-kill model. On the higher time frame, you can see that the order flow is bearish because we're consistently rejecting above highs and breaking below lows, and our draw on liquidity is lower. Our objective is to expect and anticipate weekly range expansions toward the draw on liquidity lower, and we're going to position ourselves for that range expansion, particularly around a daily candle range, or daily CRT. Just before we reach the draw on liquidity, we stop at this swing low and generate even more liquidity. Then we have a small retracement profile, which forms a candle inside a fair value gap, FVG. You can see that we first had an inside bar candle within the daily candle, and then with a down close candle, we purged the candle range high. Afterward, the price expanded lower. In this case, we would have used that candle range to frame our entry on the lower time frame. On the lower time frame, as soon as we purged the daily candle range, we then closed below the candle that actually purged the range. This led to an order block being formed. The price then tested that order block, and we expanded lower, reaching the weekly range expansion. Your entry would have been at the order block low, with the stop loss above the swing high or the order block high. You could target the daily CRT low or the overall draw on liquidity on the higher time frame. Traders, I hope you understand this trading strategy. If you have any interesting ideas or better indicators, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames and Trading. Once you're satisfied with the backtesting results, be sure to forward test your favorite strategy on a demo account. Only after that can you trade with it on a live account. If you haven't already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I do upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter or join my Telegram. Thanks for watching. Till next time, happy trading.